Module 5 Measuring Relocation Return of Investment.
Welcome back. How do you measure if a relocation is successful? If your only metric is they arrived, you are missing the point. True return of investment is measured in retention, performance, and the cultural value they are adding. Let's dive into this topic.
Welcome to Module 5, Measuring Relocation ROI. In this final session, we transition from managing the logistical activities of relocation to measuring its strategic and financial impact. The objective is to provide a quantifiable framework that proves the value of a human-centric approach. This module will equip you with a dashboard of leading and lagging indicators to demonstrate return on investment, effectively shifting the perception of relocation from a necessary cost to a strategic talent investment. The conventional method for assessing relocation is to track the cost per move. This is a critical failure of measurement. Focusing solely on logistical expenditures, flights, shipping, temporary housing captures less than 20% of the true investment picture. The dominant asset being deployed is human capital, and the primary risk is its depreciation or outright loss. When an assignment fails, the company loses not only the direct logistical costs, but also the significant investment in recruitment, training, and the projected value that employee was expected to generate. Viewing relocation through a narrow cost accounting lens is equivalent to evaluating a corporate acquisition based only on the legal fees. It misses the strategic purpose of the transaction entirely. To accurately measure success, we must expand our metrics beyond simple expense tracking. A robust ROI dashboard is required to capture the full value of a successful relocation. We recommend tracking for primary metrics. First, employee retention at 12 and 24 months post-move. This is the ultimate lagging indicator of success. High retention validates the entire investment. Second, time to productivity. This metric measures the duration from the employee's start date to the point they are operating at full capacity. A shorter ramp-up period delivers a faster return on the salary and relocation outlay. Third, promotion velocity. This assesses the relocated employee's career trajectory within the organization post-assignment. Accelerated advancement indicates a successful integration and high contribution. Finally, stakeholder satisfaction, measured via structured pulse surveys. These brief, regular check-ins with both the employee and their partner provide qualitative data on integration, well-being, and perceived support, which are direct inputs into performance and retention. To implement this, your first step is to establish baseline data for these 4 metrics against which you can benchmark the performance of your relocated talent. Effective risk management requires distinguishing between leading and lagging indicators. While retention rates and promotion velocity are definitive lagging indicators of success, they are historical data. By the time you identify a retention problem, the capital has already been lost. You must therefore track leading indicators early, signals that predict long-term outcomes. For instance, the professional and social network size of the employee's partner is a powerful leading indicator. A partner who builds a local network within the first 6 months is a strong predictor of family stability and consequently reduced risk of assignment failure. Another key leading indicator is the employee's access to internal mentorship or sponsorship. An employee who quickly connects with influential internal stakeholders is more likely to navigate the organizational culture and accelerate their productivity. Your actionable step is to incorporate questions about these specific leading indicators into your pulse surveys. Ask directly, how many new professional contacts has your partner made this month? Or have you identified a mentor within the organization? This data provides an early warning system, allowing for corrective intervention before risks materialize into costly failures. Ultimately, this data has one primary function: to communicate value to executive leadership. Your CEO and CFO operate on the logic of capital allocation. Presenting relocation as an operational cost line item positions it for budget cuts. Presenting it with a clear ROI framework positions it as a strategic investment in high-value assets. When you approach the C-suite, you must frame the discussion in their language. Do not speak of employee happiness. Speak of mitigating human capital flight risk. Do not discuss family support programs. Present them as mechanisms to protect a seven-figure talent investment. For example, you can state, our human-centric onboarding process reduced time to productivity by 35% for our relocated senior engineers, accelerating their contribution to Project Alpha, and delivering a 3-to-1 return on the incremental program cost within the first year. This reframes the conversation. Your actionable step is to build a one-page executive summary that maps your leading and lagging indicators directly to financial outcomes and strategic business objectives. This document transforms the global mobility function from a tactical support unit into a strategic partner that actively generates and protects corporate value. This concludes our course. Your task now is to implement this framework to secure your talent, protect your investment, and drive strategic growth.
I hope this was helpful. If you have any questions, don't hesitate to contact me.
Congratulations on concluding this free online mini course.